The U.S. CPI data for May 2023 was released on June 13, 2023 by the Bureau of Labor Statistics. The CPI is the Consumer Price Index and is a measure of the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. The CPI is one of the most widely used indicators of inflation in the U.S. economy. According to the latest report, the CPI for all urban consumers increased 0.4% in May, seasonally adjusted, and rose 5% over the last 12 months, not seasonally adjusted. This means that the average prices of goods and services in May were 0.4% higher than in April, and 5% higher than in May. The CPI has two main components: food and energy, which are more volatile and subject to supply shocks and seasonal fluctuations, and all items less food and energy, which are more stable and reflect underlying inflation trends. The CPI for food increased 0.7% in May, while the CPI for energy decreased 0.1%. The CPI for all items less food and energy increased 0.4% in May, matching the increase in April. The CPI data for May 2023 was slightly lower than the market expectations, which were based on surveys of economists and analysts. The consensus forecast was for a 0.5% increase in the headline CPI and a 0.4% increase in the core CPI, excluding food and energy. The lower-than-expected inflation figures eased some of the concerns about runaway inflation that have been fueled by the massive fiscal stimulus, supply chain disruptions, labor shortages, and pent-up demand amid the reopening of the economy. However, the annual inflation rate of 5% in May was still the highest since August 2008, when it reached 5.4%. The core inflation rate of 5.5% was also the highest since June. Some of the main drivers of inflation in May were shelter, used cars and trucks, airline fares, recreation, motor vehicle insurance, and household furnishings and operations. The CPI is an important measure of inflation because it affects the purchasing power of consumers and their living standards. It also influences the decisions of businesses, investors, and policymakers. For example, the Federal Reserve uses the CPI as one of its main indicators to assess the state of inflation and adjust its monetary policy accordingly. The Fed has a dual mandate of promoting maximum employment and price stability. The Fed defines price stability as an inflation rate of 2% over the longer run. However, in August 2020, the Fed adopted a new framework of average inflation targeting, which means that it will allow inflation to run moderately above or below 2% for some time to achieve its goals. The Fed has repeatedly stated that it views the current surge in inflation as transitory and largely driven by temporary factors related to the pandemic and the recovery. The Fed expects inflation to moderate as these factors fade and supply-demand imbalances are resolved. Therefore, the Fed has maintained its accommodative monetary policy stance, keeping its benchmark interest rate near zero and continuing its monthly asset purchases of $120 billion. However, some market participants and analysts have expressed doubts about the Fed's outlook and questioned whether it is underestimating the risks of persistent inflation. They argue that the Fed may be behind the curve and may have to tighten its policy sooner than expected to prevent inflation from getting out of control. The next Fed meeting will take place on June 15 to 16. The market will closely watch for any signals or changes in the Fed's projections and guidance on its policy path. The Fed's communication will have significant implications for the bond market, the stock market, the dollar exchange rate, and other asset prices. One of the assets that is sensitive to inflation expectations is gold. Gold is often seen as a hedge against inflation because it tends to preserve its value over time and can benefit from a weaker dollar. However, gold also faces headwinds from higher real interest rates, nominal interest rates minus inflation, which reduce its appeal as a non-yielding asset. Therefore, gold prices tend to react to both the actual and the perceived inflation data and the Fed's policy response. In May 2023, gold prices fluctuated between $1,800 and $1,900 per ounce, reflecting the mixed signals from the inflation data and the Fed stance. The May CPI report and the upcoming Fed meeting will likely have a significant impact on the direction of gold prices in the near term. The FOMC meeting minutes for June 2023 were released on July 5 and they revealed a lot about the Fed's views on the economic outlook, inflation risks, and policy options. In this section, we will highlight some of the key points from the minutes and how they affect the market sentiment and the gold prices. First, the minutes showed that the FOMC members agreed that the economic activity and employment had continued to strengthen since their last meeting in May, supported by the progress of vaccinations and the fiscal stimulus. However, they also noted that the recovery remained uneven and far from complete, and that the sectors most adversely affected by the pandemic had shown improvement but had not fully recovered. Second, the minutes indicated that the FOMC members were divided on the inflation outlook and the appropriate policy response. Some members argued that inflation had risen more than expected and was likely to remain elevated for some time, reflecting both transitory factors and persistent pressures from supply bottlenecks, labor shortages, and rising demand. These members suggested that the Fed should be prepared to adjust its policy stance sooner than anticipated if inflation did not moderate as expected. Other members, however, maintained that inflation was largely transitory and would decline as the effects of the pandemic faded and the supply-demand imbalances resolved. These members advocated for patience and caution in adjusting the policy stance, given the uncertainty about the inflation dynamics and the risks of premature tightening. Third, the minutes revealed that the FOMC members discussed various aspects of their policy framework and tools, including their forward guidance, their asset purchase program, and their balance sheet policies. They agreed that it was important to communicate clearly and effectively about their policy intentions and expectations, especially in light of the changing economic conditions and outlook. They also agreed that it was appropriate to continue assessing the economy's progress toward the Fed's goals and to begin discussing their plans for adjusting the pace and composition of asset purchases at coming meetings. However, they emphasized that these discussions did not imply a decision or a signal about the timing of tapering, which would depend on the incoming data and their assessment of the economic outlook. The market reaction to the minutes was mixed, as investors tried to gauge the implications of the Fed's policy stance for the interest rates, the dollar, and the gold prices. On one hand, some investors interpreted the minutes as hawkish, suggesting that the Fed was moving closer to tapering its asset purchases and raising its interest rates sooner than expected. This boosted the dollar and weighed on gold prices, as higher interest rates increased the opportunity cost of holding gold and make it less attractive as an alternative currency. On the other hand, some investors viewed the minutes as dovish, indicating that the Fed was still cautious and flexible about its policy decisions and that it would not overreact to temporary inflation spikes. This supported gold prices, as lower interest rates reduce the opportunity cost of holding gold and make it more appealing as a hedge against inflation and uncertainty. The U.S. CPI data and the FOMC meeting minutes are two important economic indicators that can have a significant impact on gold prices. In this section, we will explain why gold is considered a hedge against inflation and currency devaluation, and analyze the historical and current relationship between gold and the U.S. dollar, interest rates, and inflation expectations. Gold is a precious metal that has been used as a store of value and a medium of exchange for thousands of years. Unlike fiat currencies, gold has a limited supply and cannot be created or destroyed by governments. Therefore, gold can preserve its purchasing power over time and protect investors from the effects of inflation and currency devaluation. Inflation is the general increase in the prices of goods and services over time, which reduces the value of money. Currency devaluation is the loss of value of a currency relative to other currencies, which makes imports more expensive and exports more competitive. Both inflation and currency devaluation can erode the real returns of investors who hold cash or bonds denominated in that currency. The U.S. CPI data measures the changes in the prices of a basket of consumer goods and services over time. It is one of the most widely used indicators of inflation in the U.S. economy. The FOMC meeting minutes provide a detailed record of the policy discussions and decisions of the Federal Reserve, which is the central bank of the U.S. The FOMC sets the target range for the federal funds rate, which is the interest rate at which banks lend to each other overnight. The federal funds rate influences other short-term and long-term interest rates in the economy, such as mortgage rates, credit card rates, and bond yields. The relationship between gold and the U.S. dollar, interest rates, and inflation expectations is complex and dynamic. However, some general patterns can be observed over time. Gold and the U.S. dollar tend to have an inverse relationship, meaning that when the dollar strengthens against other currencies, gold prices tend to fall in dollar terms, and vice versa. This is because gold is priced in dollars on the global market, so a stronger dollar makes gold more expensive for foreign buyers and reduces their demand. Conversely, a weaker dollar makes gold cheaper for foreign buyers and increases their demand. Gold and interest rates also tend to have an inverse relationship, meaning that when interest rates rise, gold prices tend to fall, and vice versa. This is because higher interest rates increase the opportunity cost of holding gold, which does not pay any interest or dividends. Investors may prefer to invest in bonds or other assets that offer higher returns than gold. Conversely, lower interest rates decrease the opportunity cost of holding gold and make it more attractive as an alternative asset. Gold and inflation expectations tend to have a positive relationship, meaning that when inflation expectations rise, gold prices tend to rise as well, and vice versa. This is because higher inflation expectations reduce the real value of cash and bonds, which are fixed income assets that lose purchasing power over time. Investors may seek to hedge against inflation by buying gold, which can maintain its value in real terms. Conversely, lower inflation expectations increase the real value of cash and bonds and reduce the demand for gold as an inflation hedge. The impact of the U.S. CPI data and the FOMC meeting minutes on gold prices depends on how they affect these three factors. The U.S. dollar, interest rates, and inflation expectations. If the U.S. CPI data shows higher than expected inflation, this could weaken the U.S. dollar, lower interest rates, and raise inflation expectations, which would be bullish for gold prices. If the U.S. CPI data shows lower than expected inflation, this could strengthen the U.S. dollar, raise interest rates, and lower inflation expectations, which would be bearish for gold prices. If the FOMC meeting minutes show a more hawkish stance than expected by signaling a faster pace of interest rate hikes or tapering of asset purchases, this could strengthen the U.S. dollar, raise interest rates, and lower inflation expectations, which would be bearish for gold prices. If the FOMC meeting minutes show a more dovish stance than expected by signaling a slower pace of interest rate hikes or tapering of asset purchases, this could weaken the U.S. dollar, lower interest rates, and raise inflation expectations, which would be bullish for gold prices. Of course, these are not the only factors that affect gold prices. Other factors such as geopolitical risks, supply and demand dynamics, market sentiment, technical analysis, etc., can also influence gold prices in the short term and long term. Therefore, investors should always do their own research and analysis before making any investment decisions. To summarize, gold is considered a hedge against inflation and currency devaluation, and its price is influenced by the U.S. dollar, interest rates, and inflation expectations. The U.S. CPI data and the FOMC meeting minutes are two important economic indicators that can affect these three factors and thus impact gold prices. Investors should pay close attention to these indicators and their implications for gold prices.